Scene script. Have you ever wondered how to invest in ETFs? Well, let's start by understanding what ETFs are. ETFs, or exchange-traded funds, are a unique blend of two investment worlds. They are a type of investment fund, much like mutual funds, yet they also have the distinct characteristic of being an exchange-traded product. Imagine a basket. This basket isn't just filled with one type of fruit, but rather it's filled with a variety of fruits. In the world of finance, this basket is an ETF, and the fruits are different types of investments, such as stocks, bonds, or commodities. This collection of investments is also called a portfolio. Now, this basket, or ETF, isn't just sitting on a table in a marketplace. It's actively traded on stock exchanges, much like individual stocks. This means you can buy or sell shares of an ETF during trading hours, just like you would with a common stock. One of the main attractions of ETFs is their versatility. You see, ETFs can be as broad or as focused as you want them to be. Some ETFs aim to replicate the performance of major indexes, like the S&P 500, giving investors exposure to a wide array of companies with just one purchase. On the other hand, some ETFs focus on specific sectors, countries, or asset classes, allowing investors to target their investments more precisely. Further adding to their appeal, ETFs often come with lower expense ratios compared to mutual funds. That means they can be a more cost-effective way for many investors to gain exposure to a diverse range of assets. Plus, their structure allows for more flexibility when it comes to tax management. In recent years, the popularity of ETFs has soared among investors, thanks to these unique features. They offer a convenient and efficient way to diversify a portfolio, while also providing the flexibility and liquidity that many investors seek. Now that we know what ETFs are, you're probably wondering how you can start investing in them. Before investing in ETFs, it's crucial to understand the market. And indeed, it's a bit like stepping into a grand library. Each book in the library represents a different ETF, and the library itself is the vast, dynamic market. Now imagine walking into this library without a clue about which book to read. Overwhelming, isn't it? That's why understanding the market and its trends is so important. It helps you figure out which book is worth your time. Each ETF is unique, with its own story to tell. Some ETFs might be focused on a particular sector, like technology or healthcare, while others might have a broader reach. And just like a book, you can't judge an ETF by its cover. You need to dive deeper, researching its past performance and the sectors it covers. This process is akin to reading the synopsis, checking out the author's credentials, and perhaps even reading a few reviews before deciding whether to commit your time to a book. Similarly, the more you know about an ETF, the better equipped you'll be to make an informed decision. Understanding the market also means keeping an eye on trends. Just as literary trends shift over time, so too do market trends. A sector that's booming today might not be doing so well tomorrow. For instance, consider the rise of clean energy. If you were keeping an eye on market trends, you might have noticed a growing interest in renewable resources, leading you to invest in an ETF that covers the clean energy sector. But remember, trends can be fleeting, just like the popularity of a best-selling novel. The key takeaway here is that understanding the market isn't a one-and-done deal. It's an ongoing process. It requires continuous learning, observation, and adaptability. So before you dive into investing in ETFs, take the time to understand the market. Research various ETFs, scrutinize their past performance, and get to know the sectors they cover. Remember, understanding the market is a fundamental step in investing in ETFs. It's your roadmap to navigating the library of ETFs and making the most of your investment journey. Ready to invest? First, you'll need to open a brokerage account. This is your ticket to the world of investing, the platform where you'll buy and sell ETFs. But before you dive in, there are a few things to consider when choosing a broker. First up are fees. Some brokers charge for every transaction, while others offer commission-free trading. Make sure to weigh these costs against your investing strategy. Next, consider platform usability. Some platforms are more user-friendly than others, offering intuitive design and easy navigation. This is particularly important if you're new to investing. Finally, don't overlook customer service. The investing world can be complex, and you'll want a broker that offers top-notch support when you need it. Look for brokers with strong reputations for customer service. Opening a brokerage account is a crucial step in your investing journey. Once your brokerage account is set up, you're ready to start investing. Now, let's dive into the process of buying your first ETF. So you've done the research, you've opened a brokerage account, and now you're ready to take the plunge. Let's walk through the process of buying your first ETF. Firstly, you'll need to log into your brokerage account. On your dashboard, you should see an option to trade or buy stocks. Click on this. You'll then be directed to a page where you can search for the ETF that you want to buy. Remember the ticker symbol that we discussed in the earlier scenes? That's what you'll need to enter here. Once you've found your ETF, you'll need to decide how many shares you want to buy. This is a personal decision based on your budget and your investment goals. Don't worry, you're not locked into this decision forever. As your goals and circumstances change, you can always buy more shares or sell some off. After deciding the number of shares, you'll need to place an order. There are two main types of orders you can place: a market order and a limit order. A market order means you're willing to buy the ETF at the current market price, whatever that may be. A limit order, on the other hand, allows you to specify the maximum price you're willing to pay per share. Once you've decided on the order type, click the Buy button to finalize the transaction. You'll be prompted to review your order before it's submitted, so take a moment to double-check everything. If it all looks good, confirm the order. And just like that, you've bought your first ETF. It might seem a bit daunting at first, but remember, every investor started somewhere. The important thing is that you're taking the first steps towards building your investment portfolio and securing your financial future. Congratulations, you've just bought your first ETF. Investing in ETFs doesn't stop at buying your first one. It's like setting off on a road trip. You wouldn't take just one road to get to your destination, would you? You'd use a map, plan your route, and use different roads to avoid traffic and roadblocks. Investing is similar. You need to diversify, to use different financial roads to reach your investment goals. Building a diversified portfolio of ETFs is a strategic way to spread your investments across various asset classes, sectors, and regions. It's about not putting all your eggs in one basket. When we talk about diversification, we're talking about the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help reduce the risk of a significant financial loss if one investment doesn't pan out as expected. Diversification doesn't guarantee profits or protect against losses, but it can help you create a balance between risk and reward based on your investment objectives and risk tolerance. You see, different investments perform differently under various market conditions. By investing in a variety of assets, you are less likely to suffer a major loss when one investment performs poorly. Imagine you have a portfolio solely invested in technology stocks. If the technology sector takes a hit, your entire portfolio suffers. But if you hold a diversified portfolio with investments in technology, healthcare, utilities, and consumer goods, a downturn in the technology sector may be offset by the performance of your other investments. Maximizing potential returns is another reason to diversify. When you diversify, you're not just spreading risk, you're also creating opportunities to benefit from the growth in different sectors and asset classes. To build a diversified portfolio, consider ETFs that track different sectors, asset classes, or regions. For instance, you might include ETFs that track technology, healthcare, and real estate sectors, or ETFs that track US, European, and emerging markets. Remember, a diversified portfolio is key to successful investing. It's about balancing your risk and reward and navigating the investment journey with a well-planned roadmap. So, you've learned the basics of investing in ETFs. We started off by introducing you to ETFs, unraveling their immense potential as an investment tool. We then delved into the labyrinth of the market, breaking it down into digestible chunks for you to understand its dynamics. Next, we walked you through the process of opening a brokerage account. We emphasized the importance of choosing a reliable broker who can become your ally in this investment journey. Our journey continued with buying your first ETF. We demonstrated how to evaluate ETFs based on various factors such as their performance, cost, and relevance to your investment goals. Finally, we explored the art of building a diversified portfolio. We stressed the significance of diversification in minimizing risk and maximizing returns. Remember, it's not just about investing, but investing smartly. With these steps, you're well on your way to becoming a successful ETF investor. Happy investing!